BitMine is sitting on $7.8 billion in unrealized ETH losses, and Tom Lee just told it to buy more. BitMine Immersion Technologies bought 60,976 ETH last week for approximately $193 million, its largest single-week acquisition of 2026 in token terms. The purchase pushed the company's total Ethereum holdings past 4.53 million tokens, valued at roughly $9.14 billion at ETH's current price of $2,050 as of March 9, 2026. Chairman Tom Lee said the firm believes crypto prices are in the late final stages of the mini-crypto winter and announced the company is slightly increasing its accumulation pace. The Decrypt report confirmed this is BitMine's largest weekly purchase by volume in 2026, $9 billion in ETH and $7.8 billion underwater. The headline number is the treasury, the buried number is the loss. BitMine's 4.53 million ETH position carries approximately $7.8 billion in unrealized losses, a figure that reflects the gap between its average acquisition cost and Ethereum's current price near $2,000. For context, that unrealized loss is larger than the entire market cap of most Layer 1 blockchains. BitMine has been running the same playbook that Strategy, formerly MicroStrategy, made famous with Bitcoin. Buy consistently, hold indefinitely, and use treasury accumulation as the core business model. The difference is the asset. Where Strategy bet on BTC as a reserve asset, BitMine has concentrated entirely on ETH, staking its holdings to generate yield rather than letting them sit idle. The company's stock, BMNR, traded at $19.49 on the day of the announcement, up 3%. BitMine also holds $1.2 billion in cash and roughly $13.4 million in Bitcoin, but the Ethereum position dwarfs everything else on its balance sheet. Tom Lee's Nobody Rings the Bell thesis. Tom Lee, who chairs BitMine's board, framed the increased buying as a response to market signals rather than a blind accumulation. Ethereum prices showed resilience this week in the face of rising war concerns and surging oil prices, Lee said. We continue to believe that crypto prices are in the late final stages of the mini-crypto winter. His follow-up line was more pointed, nobody rings the bell at the bottom. Lee is effectively arguing that the worst of the drawdown, which saw ETH fall from its cycle highs to briefly dip below $2,000 this past weekend, is either over or close to ending. The timing is notable. Oil prices surged past $110 earlier this month on Middle East escalation, and the U.S. economy shed 92,000 jobs in February, creating the kind of macro headwinds that typically suppress risk assets. For BitMine to accelerate buying into that backdrop is a statement about conviction. The company had been purchasing 45,000 to 50,000 ETH per week before this latest increase. Jumping to 60,976 in a single week represents a roughly 22 to 30% ramp in acquisition pace. The staking machine behind the treasury. What separates BitMine from a simple buy-and-hold play is the yield layer. The company has staked approximately $6 billion worth of its ETH holdings and currently generates $174 million in annual staking revenue. That figure comes from over 3 million tokens earning network rewards. BitMine plans to stake its entire position through the Made in American Validator Network, MAVEN, a domestically operated validator infrastructure. Once fully deployed, the company projects annual staking revenue of $259 million, a 49% increase from current levels. That $259 million projection matters because it provides a revenue floor that exists independent of ETH's price. Even if Ethereum trades sideways for a year, BitMine collects staking rewards. It is the same logic that makes staking-enabled crypto cards attractive to retail holders. Put your assets to work rather than letting them sit idle in a wallet. For comparison, the $174 million in current annual staking revenue covers the cost of last week's $123 million purchase in roughly 8 months. BitMine is essentially using yield to fund further accumulation, a flywheel that tightens with every token added to the staking pool. What this means for ETH holders: BitMine's $7.8 billion unrealized loss, and its decision to buy more anyway, sends a specific signal to the market. The largest Ethereum-focused treasury firm is not reducing exposure, it is adding. Whether you interpret that as conviction or stubbornness depends on your view of ETH's trajectory. For retail holders, the staking revenue angle is worth watching. If BitMine can generate $259 million annually from validator rewards, it validates the thesis that Ethereum's staking yield is a durable income stream, not a temporary incentive. That has downstream implications for anyone holding ETH in a self-custody wallet or through an exchange that offers staking. The mini crypto winter framing also matters for timing. If Lee is right and the bottom is forming, ETH's current price near $2,000 becomes a reference point for the next leg up. If he is wrong, BitMine's unrealized loss grows and BMNR shareholders absorb the impact. The broader treasury playbook BitMine is the second largest crypto treasury firm by total holdings, trailing only Strategy's Bitcoin position. The two companies represent different bets on which asset will define institutional crypto treasury strategy. BTC as a store of value or ETH as a yield-generating productive asset. Strategy recently pushed past 738,000 BTC with another $1.3 billion purchase, also buying below its own cost basis. The parallel is striking. Both firms are doubling down during a drawdown. Both are sitting on substantial unrealized losses, and both are framing the current environment as a buying opportunity rather than a warning sign. The key difference is yield. Strategy's Bitcoin sits in cold storage, generating no income. BitMine's ETH generates $174 million per year and growing. Whether that yield advantage matters more than Bitcoin's liquidity premium is a debate that will play out over the next cycle. For crypto card users, the institutional accumulation trend has a practical implication. Large-scale buying from treasury firms reduces available supply on exchanges, which can affect the spreads and conversion rates that card providers use when processing transactions. More institutional holding means less exchange float, which historically tightens spreads for everyone.